So, thank you very much for inviting me here to the Oxford Belfry. Interestingly, I live about a quarter of a mile from the Cambridge Belfry. And not that there's any competition between Oxford and Cambridge, of course, but I have to say, this one's much nicer. I should actually say that. So, an introduction to capital allowances. Quite a complex tax subject we'll be talking about for the next 3 hours. Only joking, of course. About 40 minutes or so, I'll go over the very basics of capital allowances and introduce the subject to you. There will be a bit of a competition part way through, just an informal one for you. So, today, you're going to get an overview of capital allowances, this magical word. I'll show you what types of properties will qualify for this tax relief, typical savings, some examples of some properties as well, so you can relate it to the real world. And some quirky tax reliefs, which are quite funny and might apply to some of you. So, capital allowances. Well, capital allowances cover a whole host of very exciting tax reliefs. Who is excited by tax relief as much as me? Of course, I can tell you all are. So firstly, we're going to go over plant and machinery allowances. We're going to talk about building premises renovation allowance. Just trips off the tongue, that one does. BPRA, land remediation relief, not as exciting as it actually sounds. Enhanced capital allowances for the future environmentally friendly solutions. And flat conversion allowances, which are perhaps a lot more used than you would think. Excited already? Of course. Okay, so capital allowances are a tax relief for capital expenditure on items of plant and machinery. But what is plant and machinery? Interesting question, thanks for asking. Plant and machinery, interestingly, there's no definition. You go to the revenue and it even says there is no definition of what's plant and machinery. So you can assume certain items which, you can assume certain things which can be determined to be plant and machinery, mainly from case law. So over the last number of years, there's been various cases where people have gone to the revenue and said, you know, I think these are items of plant and machinery. Let's have a discussion around that. They do, and in some cases, the revenue backs down and says, okay, yes, we accept it's an item of plant and machinery. So there's a whole host of these things. Some typical examples are here. Electrical systems. We've got installations, cold water, solar shading, heating, air conditioning. These are all the main things that you would expect. Normally you say plant and machinery. Most people think well, diggers, tractors, you know, that sort of thing. Hymax. I never knew what a Hymax was until about 2 years ago. But I shan't bore you with that either. Lifts, escalators, and a whole host of other things. These magical things which are deemed to be plant and machinery. So there's many more of these, but again, it's determined on a case law basis. So why do we have them? Well, surprise, surprise, depreciation is not tax deductible. Now, there'll be business owners here, and you get this magical thing called a profit and loss account. We're all aware of what a profit and loss account is, where you have your income, your turnover, your operation costs, and it gives you a nice net profit, hopefully a big net profit at the bottom. We all love a net profit? Yes, we do. But there's also a depreciation charge in there, where you spread the cost of that asset over its useful economic life, 5, 10, 15 years, whatever it might be, which is fine. Everybody accepts that. But when it comes to doing your tax computations, who loves a good tax comp? Yes, I'm sure you do. When you do your tax computations, depreciation is not tax deductible. Instead, the revenue allow you to claim these things called capital allowances. But if that's new to you, you might think, well, when did this happen? And this is where the quiz comes in. Who loves history? Anybody good at history? Yeah? Favourite year? 1945? Of course it is. But guess the year. So guess which year this happened. Benjamin Disraeli, the first Earl of Beaconsfield and Viscount Hughenden, he introduced the Royal Titles Act to promote his close friend Queen Victoria. Which year was he Prime Minister? Anybody guess? Any guesses? 1880, that was a good guess. I like that. Let's try this one. So William Armstrong is the first home to have an electric light bulb. Can you imagine that, eh? You can't live without them anymore. Any ideas which year that was? 1890. 1890. Very good. You know your light bulbs. I like it. Queen Victoria. She was on the throne. The first Empress of India. Did you know she had 9 children? Can anybody name them? That was her husband, wasn't it? I'm sure she had some. She survived 6 assassination attempts. The year that all these things happened, it was, of course, 1878. So very good, someone who said 1880 there. Now, interesting story. Back in the late 19th century, the Treasury at the time didn't have much money. Much like today, you could argue. So they sort of got together and they said, right, okay, this isn't very good. We haven't got much money. What can we do to influence this? So they decided that one of the few things they could influence is the depreciation of certain assets. Because companies and businesses were depreciating their assets how they wanted to do it. So really, they were depreciating them quickly, so they had less profits, therefore paying less tax. But the Treasury didn't like that, so they introduced the Wear and Tear Act. Different to today's meaning of wear and tear, but they introduced that in 1878. And that act went on to say that, as I explained, depreciation is not tax deductible. Instead, we, the Treasury, the Revenue, will tell you how to tax depreciate your assets. And hence, capital allowances was born. So there you go, a bit of history there for you. So, if you invest money, which you do, because you're buying properties, if you buy a holiday home, a multi-let, then you, as an investor, are contributing to the economy. How good do you feel now? Contributing to the economy. That's fantastic. You're increasing the circulation of money, using services, goods, builders, all those local people you employ, generating and creating business. God, you must feel really good now. And for this, you're entitled to get some tax relief. Even better. That's the icing on the cake, isn't it? Not only are you investing, contributing to the economy, making profits, you're also entitled to some tax relief. Amazing. You must feel so happy when you wake up in the morning. So there's a few things we should know about capital allowances. First of all, it's not restricted to property profits. So, what does that mean? Well, if you think about it like this, you might have lots of different income streams. You might have income from property on one side. You might have dividend income. You might have a job. Anybody got a job? J-O-B? Yeah, well done. You pay income tax on those jobs. So you have lots of different income streams. And what capital allowances allow you to do is they allow you to take the tax relief from your properties and use it against any other taxable income. Well, that sounds like a good idea, doesn't it? I like the sound of that. So I own these properties. They attract tax relief, and I can use that to offset the tax that I pay on my job. I think that's great. And I love the idea of going into someone's business and perhaps somebody saying to their boss, you know, how much did you earn last year? Yes, I earned this, yes, but I got all my tax back. How much tax did you get back? So you could actually be earning more than your boss. Who likes the idea of earning more than their boss? Of course you do. It sounds great. So you can claim on holiday lets, commercial properties and residential works as well. Capital allowances are between 8% and 150% of your investment. What? That's 150%? That's a typo, isn't it? No, actually, in some investments, if you spend £1, you can get £1.50 back in tax relief. Well, that's mad, isn't it? I'll show you how that works. And the revenues say that 96% of people haven't claimed. It's just ridiculous, isn't it? The world's gone mad. There you go. I'll expand on that. So what are they worth? What are capital allowances worth? Well, the value, you have to look at everybody's individual cases. There's a whole host of variables. If you don't pay any tax, how much tax are you going to get back? Exactly. So you could own £10 million worth of property. No capital allowances are worth anything for you if you don't pay any tax. the capital allowances that you identify is not what you get back in a tax saving, so you have to take your tax rate into account. So very simply, there's 3 little rules down here, and it's helpful if we remember those. Hopefully you can all see those. Oh, there's screens at the back. Well done. Well planned. Rule number 1, capital allowances save tax, so there must be a liability. So I was talking to somebody earlier who hadn't paid any tax for the last 5 years, but in the year coming, they've got a tax liability. And that is when they would benefit from capital allowances. Rule number 2, they cannot be claimed by non-taxpayers, such as pension funds. So, who do you think has lots and lots of property in the UK that can't claim any of these? Pension funds. Okay, apart from pension funds, I guess that's one answer there. Local authorities, for example, all of the buildings that they own, masses and masses of them, because they don't pay tax, of course, they don't operate on a profit basis, they can't benefit from any capital allowances, which is good from a compliance point of view, because if you buy a property from one of these entities, you know that you are entitled to all these allowances. I'll talk a bit more about that a bit later. And number 3, capital allowances are valuable to a business person, I've forgotten what I wrote, so I'll have to read it, that temporarily has no tax liability. So if you can't use them, they may be of value later or to someone who owns the asset in the future. So what that means is that if you have a loss, a property loss, and you want to increase that loss for whatever reason, you can use the allowances to do so, and it will just prolong the amount of time that you have until you pay tax. And there could be certain circumstances when that's beneficial. So here's some typical values of some properties that we find, just to give you an idea on what they're worth. Nice, big, fancy offices that we have, sometimes up to 50% of their value are items of plant and machinery within them. So you've got heating, you've got cooling, air conditioning, Cat 5 installations, see these funky underfloor power and false floors, what they do in offices, all of those sorts of things, security, all add. And hotels as well. Hotels are great. Swimming pools are items of plant and machinery, would you believe? So therefore you can claim for those. And some more ideas on there. Now what can be claimed? So you buy a property. Who here has bought a property? Yes, I'm sure you all have. So you buy a property. What do you buy? You buy bricks. Bricks on your property? Yeah, there's bricks on your property. There's a roof on your property. You would like to hope. You buy those. You buy the foundations in your property. You hope so. But you also buy everything within it. All the pipework, all the electrical wiring, all of the doors, all of the carpets, all of the kitchenware, all of the sanitary ware. All of those are items of plant and machinery. So therefore, because you bought those, you're entitled to claim those as tax relief. Well, that sounds a little bit exciting, doesn't it? If you develop a property, you're going to incur expenditure on items which are plant and machinery, so you can claim those. And you refurbish or alter existing property, you can do the same. An expenditure incurred directly or indirectly on land remediation relief. There's that word again, land remediation relief, well spotted. We'll let you know a bit more about that a bit later. And again, expenditure incurred in bringing back into use a building which was previously derelict. Who enjoys looking around a nice derelict building? Yeah, be honest, we all do, don't we? I should keep an eye out for derelict buildings. There's some really good tax reliefs which I shall share with you. So how can they be claimed? Through the self-assessment process. Tax returns. Yep, we're all probably in the process of organising tax returns. You're probably all very efficient and done it months ago, I'm sure. But you claim them through the tax assessment service. Very easy. There's some boxes you should remember. I did make a mistake and quote last year's boxes on the tax return and not this year's. I think it's box number 34, 32 and box number 42, I believe, this year in your tax return. Very important boxes. If you don't fill those in, you can't get the capital allowances tax relief. It relates to property-related profits and, again, not restricted against any taxable income. And amendments can be done for open tax years. So many people are not aware of this. So you did your tax return last year for the 10-11 tax year, did you know you can still go back and change that tax return? So if you want to claim capital allowances in that tax year, I mean, you've got to be quick. You've only got like 8 days to do it. But once you've submitted your return, the revenue still give you another year to make any changes to it. So you can go back and amend that. Not a lot of people know that. Oh, I sound a bit like Paul Daniels, was it? He used to say that? So yeah, that's quite an interesting thing to do. So it means that it opens up more tax available to you to go back. It's a tax mitigation process. There's no credits available. Although, now I've just said that, there is actually one credit available, this Magic Land Remediation Relief, which I'll cover very shortly. I can see that you can't contain your excitement much further. So, here's how it works in the real world. This is Johnny. Well, this isn't Johnny, this is Johnny's numbers, but this is based on Johnny. Johnny is a very lucky chap. He's got a job. He gets some income, which he's happy. He's also got investments as well. So he earns £35,000 a year. He's happy with that, but he pays tax. He's not so happy about that. So the way that it works is, there's his taxable income. He's got £10,000 profits from his property portfolio, so his total income is £45,000. He has his personal allowance of £7,500, and so his net taxable income is £37,500. The tax he would pay on that would be £8,000. But he's not so happy about that. So he phones me up and he says, Arthur, I say, hello, yes, can I help? We have a bit of a dialogue. And I say, if I find you £10,000, wrong number, if I find you £10,000, here's how it will look. And we talk through it. So he still has his job, £35,000. The £10,000 worth of allowances will go off against his property income. So that drops his net taxable income to £27,000. And therefore, his tax paid would be £5,500. That's pretty straightforward, isn't it? So I've saved him £2,500. I said £3,500 last year and realised I got it wrong. But, I say, if we find you more, say we find you £15,000, here's how it will work. You still have your income through your job, well done, still employed, £35,000, congratulations. The profit from your property is wiped out by 10 of the 15,000. So you still have your personal allowance, everybody gets that automatically. You've got an additional £5,000 loss, augmented by capital allowances. Good word that, thanks. £5,000. So now your net taxable income is 22,500. So it's down to £4,500 in tax from 8,000. And of course he's very pleased with that. So that's just an idea of how it works in the real world. It's exciting, isn't it? All still awake? Well done. Now, do you have to give these allowances back? Well, if you claim capital allowances and you sell your property that you claim capital allowances are on, there is a chance that that tax relief could be clawed back. However, there's a few things that can be done to stop that. The main one is to have what they call a Section 198 election. Oh, that sounds exciting, doesn't it? Section 198 election. I'm sure you've all heard of people buying assets for £1. And you buy a big property and all of the furniture and fixtures and fittings you buy for £1. That is an example of a Section 198 election. It's becoming more relevant because the rules are changing to put into force the pooling which has to be done from 2014 onwards. But for the time being, what you would do is you would say, yes, I'm still selling that property for 300, 400,000, but the plant and machinery within that property, I'm selling you for £1. So I'd sell the property for 399,999 and the plant and machinery for £1. So it won't change the sale price, but it means you're entitled to claim the rest of the allowances you've already identified. Now there's a few things we should talk about this very briefly, because invariably when you buy a property, it might be the previous owner has already claimed, unless you buy from the local authority or a pension fund, and they obviously can't do it. So part of the compliance process that we have to go through is to check all of the previous owners back to July '96. I've got a lady in my office called Jill, who's a very nice lady. She's my compliance manager, and that's her job to check everything. This is kind of a how long is a piece of string kind of job. I'll give you an example. A very quick process would be a client of mine bought a property in Bournemouth Road in Poole, very nice part of Bournemouth, or Poole, I suppose. And I phoned the previous owner up, a gentleman called Steve Bolton. You might have heard of him. I phoned him up and I said, hello, Your Eminence. My name's Arthur. I'm phoning up to check if you've claimed any capital allowances. And this was about 3.5, 4 years ago. And he said no. He said, haven't claimed any capital allowances, don't know what you're talking about. So that was very easy. And we could check the previous owners and get contact details and assess very quickly that nobody had claimed any capital allowances, which is fine. Which means the new owner, my client, is entitled to claim all of the allowances. There's none of this clawback going on. And that was a very quick solution. Right at the other end of the scale, it can sometimes take months to find out, A, who the previous owners are, and B, get confirmation if they've claimed capital allowances. Can you imagine the most efficient of businesses, let's say banks, for example? Very often, banks own properties, and how difficult do you think it is to try and A, speak to the right person in the bank that would know about that property, and B, for them to get the right paperwork out to you? I'll give you a clue, not very easy. So sometimes it takes a long time. So whenever we take a case on, the time it takes to complete it varies depending on how difficult the history is of that property. Some cases it's very easy, like Steve. So that's something we should be aware of. Different types of qualifying expenditure attract annual allowances at different rates. Annual allowances, they're even more exciting than I thought. And you can claim them on the first year of expenditure. So what is the value of plant and machinery? So we talk a lot about these values of plant and machinery. How quickly can you get them? If you buy a property today that's got £100,000 worth of capital allowances in it, can I use those all at once? Well, the answer is maybe. Not very clear, I'll grant you, but generally you can claim on general plants 18% per year of the value that is found. Integral features, 8% a year. Thermal insulation, 8%. Long life assets, 8%. But energy saving plant, 100% in year one. And of course, the government are very good at this. The government are very proactive when it comes to carbon neutral and the carbon footprint and all the agreements that they have to make. So they encourage you, as investors, to buy any environmentally friendly plant that you can. And if you do, if you have a boiler that meets certain requirements in terms of energy efficiency, you can claim the cost of that boiler all at once in year one. More about that very shortly. So when are they available? April 2008, I'm sure we all remember exactly where we were on that day. April 2008, the revenue stopped using what they called first-year allowances. I'll give you an example. I used to be the UK accounting manager for a large, without saying their name, Swedish furniture blue and yellow company. And invariably they would spend quite a lot of money on building new stores. You know, they're not cheap, are they? And for sake of argument, if they spent £50 million building a store, there would be, say, £20 million worth of plant and machinery, as an example. Before April 2008, the revenue said, OK, in year one, when you buy or make that acquisition or building, you can claim 50% of it as a first-year allowance, which was great. £10 million worth of tax relief in year one. Fantastic. April 2008, they stopped first-year allowances and they introduced the annual investment allowance. Good move, you might think, but here's the thing. The annual investment allowance was limited to £50,000 at the time. So all of a sudden, if you're a large business that has these properties, your £10 million worth of tax relief goes down to £50,000. Well, that's not great, is it? No, that's not good at all. That means more tax bills. And that was partly why the annual investment allowance was introduced, because it reduced businesses' tax relief, and therefore increase their profits, more tax, thank you very much. So that's why they introduced the annual investment allowance. And you may all be aware that in the autumn statement, the Chancellor, God bless him, increased the annual investment allowance from £25,000 to £250,000. That means if you buy property that attracts £250,000 worth of capital allowances, you can earn that much tax-free. Who wants to earn £250,000 tax-free this year? Yes, thank you. No, there's only about 5 people doing that, no? Madness. So every year, the first year allowance used to change 40 or 50%, depending on the various Finance Act for that particular year. But they introduced this annual investment allowance. So yeah, what is it? Well, I think I've probably just explained that. So it was £25,000, and there was so much pressure from everybody in business, the Chamber of Commerce, various other professional bodies went to the Chancellor and said, look, £25,000 for people investing in property is not very much. Give them something to get excited about. So he increased this level to £250,000, which covers, I think it's 96 or 98% of businesses and individuals that invest in property. So you can claim your tax relief. Very exciting stuff. So why aren't they automatically claimed by accountants? Now, accountants are very, very good. This is a particularly niche area of tax, and you need to have a number of different skills in order to be able to, A, visit the site, identify what is actually legally plant and machinery, to be able to value those assets, and to be able to understand how it links with tax relief and make sure that all the reports are produced in accordance with the Revenue's own guidelines. So it's not, because it is such a niche area of tax, it's not something that most accountants in practice will get involved with. But they do a very good job. I'm not saying anything about that on there. So types of capital allowances, the exciting bit. Types of capital allowances. Properties. So we talked about plant and machinery allowances. So they include these various items that we put on here. Heating and air conditioning, lifts. Everybody likes a good lift. Wiring to fixed plant, switchgear, emergency lighting. Fire alarms, sound, all these things which are deemed to be plant and machinery. It's not exhaustive, but it gives you an idea of the sorts of things that qualify. And it varies from 100% to 8% tax relief. So here we have, that's a good looking building, isn't it? So this in Milton Keynes is a block of flats. Very nice block of flats. Bought for £3 million, and it was, I'll say build date in July 2009. It was kind of complicated, but somebody bought it directly from the builders. And the capital allowances that property attracts, lifts, underground parking, all this sort of thing, was £455,000. So what that meant to the owner, it was owned by a corporation, a limited company. It meant that it reduced their tax bill, their corporation tax bill, by £95,000. And this was something that they'd obviously bought the property for investment purposes, to generate rental income from the, I think it had 21 self-contained flats, if I remember correctly. They're using it to generate profits, and the tax relief is an added bonus to them, but nevertheless a welcome one. I don't even know where to point this. There you go. So there's a property in Oakshott. Well, if anybody's ever been to Oakshott, lovely part of the world. This was bought for £435,000. If my memory serves me correctly, because it was quite a while ago, the owner bought it as a family home to live with, well, his family, and then had a job offer abroad, I believe, so let it out as a multi-let. I think it let it out to 4 or 5 different individuals. Obviously, we went in there and undertook a survey, all the communal areas of the properties, the non-dwelling areas. We identified the plant and machinery. £35,000 of capital allowances. He was a 40% tax rate, 40% tax rate payer at the time, meaning he got £14,000 off his tax bill. He was quite happy with that. for that particular year. But that gives you an idea of kind of the higher end multi-lets. To be fair, not many multi-lets you find like that. Certainly I don't. This one was a property in Cyprus, very nice. I must admit, I did have to pull rank over my surveyors and I have to go out and do this one. But typical, isn't it? I got there and it was bloody cloudy. Would you believe it? So this was a very nice place. So lucky, the people that developed this. They're quite in with the church in Cyprus, and they managed to get a big plot of land where they built about 10 of these on there, sold them off, right on Turtle Beach, which is owned by the church, and they got the land, developed these really nice holiday lets, built in December a few years ago, and yeah, nearly £500,000 worth of capital allowances. The owners, married couple, are both 40% taxpayers, so over time it's going to save them nearly £200,000 off their tax bill. So that, very nice. I did enjoy that one. Although the wife wanted to go with me, which costs some more money. Anyway, so this is a pub. I'll grant you, not the nicest pub in the world, but nevertheless, a pub called the Cricketers Arms in Preston. If you ever go to Preston, I wouldn't recommend this pub. It's not that great. But bought for £140,000. The owner has done something with his properties, which I've got another example of a bit later. He likes to buy older properties like this and convert them into more residential properties. Some great tax reliefs there as well. That says build date, but he actually bought it in December 2010, and we identified about £19,000 in cash savings for him for that particular property. Massive out the back, that property. Very nice. This is Northampton. This is more like it. Northampton, great place if you've ever been. Not this part, unfortunately. £85,000 this property was bought for. So £85,000, buying a property for £85,000. We identified under the 6608 rules, I'll come on to that a bit later, nearly £17,000 worth of allowances, which saved the owner £3,500 off their tax bill. But let's put this in perspective. How much money would you have to put down for an £85,000 prop? £15,000, £20,000, something like that? To get 3.5 back, that makes a massive difference to your investment there. Phenomenal. And obviously you're still getting rental income. The main purpose of the investment, of course, is to make your profits, and that should always be the first thing that you look towards. You make the business decision to buy the property, and the tax element of it is almost like an added bonus, tax bonus. This is in Birmingham, £195,000, 20% taxpayer. Not an awful lot of this property did qualify, but still saved the owner £3,000. And that's a funny story, I'll tell you another time. More polite, different company, should we say. So this is a dentist surgery where they bought the original site, levelled it and built a dentist surgery there a couple of years ago, 18 months ago or so. And we identified quite a large proportion. Because they've already bought the land, we don't have to take into account the land valuation, so it is purely just the build costs. And of course, more of the actual overall investment is plant and machinery, as well as apportioning it to the land. So again, 2 dentists. I mean, who knows a poor dentist? No one, right? They always do well. So they're 40% taxpayers, so they're saving over £80,000 off their tax bill. Lincoln. Now this is interesting. This is a really nice place. It is. Somebody said it's a school. It was actually, I've got to remember, it was a care home beforehand, owned by the local council. My clients here, the company, took over the running of that care home, very quickly closed it down. So they were entitled to claim the capital allowances of the business when they took it over, because it's a local council. They'd fitted it out to a really high standard, can't claim any tax relief. Perfect. So my clients went in there, bought it. I think the operating costs for the local council, well, every local council, is always being looked at, and if they saw an opportunity to perhaps outsource it, they might have done so. I don't know if that was the case or not, but it worked out well. So they took over the running, closed it down, claimed the tax relief, and then they set about converting it into residential units, of which they could claim some of that as well. So fantastic opportunity there, and very tax efficient as well, as you can see. But interesting, and there's an awful lot of these empty ex-council buildings that are available. So that's plant and machinery allowances, some examples on there. Flat conversion allowance. Have a guess what that's an allowance for. Yeah? It's one of those, what was the name of that company with the tin? Whatever it's called, One Seal, was it? It does exactly what it says on the tin. If you convert a premises into flats, you're entitled to flat conversion allowance. Now, I'm kind of giving on one hand here and taking away with another, because the whole point of today is to give you this information, and so you can go away and you can say, oh yes, this might be relevant to me, and it might be the case that if you're looking at a particular deal or looking at a particular investment, that is something that may sway the decision if there's some additional benefits on there. If something doesn't quite stack up, but you know you can get a massive tax relief or rebate, it could make a difference. So this is flat conversion allowance. Now, this was introduced by the revenue to encourage investors to use space that's already there. So rather than buying a plot of land and building a whole new building, there's so much space that isn't being used. And we've all seen these rows and rows of shops where they've got empty storage above and empty flats above, loads of them everywhere. And this is what this was designed to do. If you, as an investor, as a developer, buy these properties, as long as you meet these rules here, which a long list of rules, but it's really not that difficult. As long as you meet these rules, you're entitled to claim 100% of your costs in converting the dead space into livable space as tax deductions. So you're going to treat it as capital, right, because you're improving the property. So it'll go against your capital gains tax should you sell it in the future. But you can also claim all of that against your taxable income as flat conversion allowance. And that's the incentive the revenue give you here to say, OK, use the dead space, don't build new buildings, use the dead space, you get the tax relief for it. So there's a few caveats and rules, but under Section 393, as long as all or most of the ground floor is authorised for business use, then it qualifies. Authorised doesn't necessarily mean it has to be trading. And as the example I'll show you in a second demonstrates that. It has to be no more than 4 stories above the ground floor, and it has to be built before 1980 originally. Primarily, the stories above used as dwellings. The upper floors have to be unoccupied for a year. And there's one really funny one. What is it? So here. So I don't know if anybody's ever seen a flat like this. So each flat has no more than 4 rooms, ignoring kitchens, bathrooms, closets, and hallways. So I guess if you've got, I don't know, 3 or 4 bedroom flat or something, and they're not let to a person connected with the conversion. It ends, unfortunately, in about 3 months' time. So you might have already started or perhaps looked at a project or actually done this, and in which case you would be entitled to some tax relief. A really good tax relief, and perhaps if you'd known about it 2 or 3 years ago, then it might have been more relevant. But nevertheless, it's out there. And they might bring it alive again. So here's some examples. Here's my client up in Preston again. This used to be a pub. They used to be called the Derby Inn, I think it was, up in Preston. Have a look at it. There's some really nice old pictures. Really quite a bad. I wouldn't recommend going drinking there when it was the Derby Inn before again, because it's really not very good. But what he's done is he's converted it into flats, lettable flats, I think 6 or 7, extended it round the back as well. And what he's done is the bottom floor, half of it, he's advertised it as offices. And so they kitted out for offices. They got some Cat 5 and emergency lighting and this sort of thing. And he's letting them, well, he hasn't let them as offices, but his plan is that he will advertise them as offices, and then if it doesn't work out, then he can easily convert them back into residential units. But this meets all the requirements for him to claim flat conversion allowance on the property. And he spent, well, you can see from the purchase and development costs, he spent a lot of money doing it. You can only see half the building there. But nevertheless, very valuable, a very good tax relief for him on that. So that was this one. And a very similar situation with a pub. Pubs are great for this sort of thing. And there's so many of them empty around, right? What is it now, like 10 closing a week or 50 a week or something ridiculous? Great opportunities there. This was quite a while ago down in London. My client did exactly the same thing, converted the upper floors, extended them for residential flats, let them out, left at least 50% of the ground floor lettable for offices. Because of all that, he met the conditions for flat conversion allowance and could claim that tax relief. Who likes a bit of flat conversion allowance? Yes? We do. Yes?
What happens if in the future he goes for planning permission and turns the offices into residential?
An interesting question. For those that didn't hear, what happens if he goes for planning permission and converts it back? Well, here's the thing. My wife always tells me off for kind of going round the houses to answer a particular question, but bear with me on this one. Now, who's read the Capital Allowances Act 2001? Yeah, I know we all have. It's dead exciting, I know. But in it goes on. There's a section on there that says about you have to have an interest in a property. But guess what? They never defined what an interest in a property is. So, not until a few years ago. But basically, on this particular case, you have to have an interest in that property for at least 7 years. So that means that if the owner sells the property before 7 years, then there would be potentially some clawback of this flat conversion allowance. Likewise, if the property didn't qualify for flat conversion allowances by converting the offices back into residential, then there would be a clawback for some of that as well. So, in answer to your question, there would be a clawback of the tax relief. However, you could take the approach that, are the revenue going to knock on your door and have a look at your property and see if there's offices there? Chances are they probably won't. However, my sort of view is, if you're benefiting from this tax relief, which is a massive tax relief, and you can get people who are going to rent the offices out, you probably get as good rental income from the offices as you would residential. Perhaps not quite, but it satisfies the need for the tax relief. But if they were to convert them back, there would be a partial clawback of the tax relief there. So BPRA, Building Managers Renovation Allowance. There you go. Like I say, trips off the tongue, that one does. This is really interesting and really relevant. This is one of the very few tax reliefs that the Revenue looked at and said, well, this is a good idea. I'm glad we came up with this one. Let's keep it for the next 5 years. So this is available at the moment until April 2017. What this is, derelict or unused commercial properties, bringing them back into use. Now, it might not necessarily be available for you as investors or particularly your particular types of properties that you're investing in. However, there's some really quite interesting schemes that are going up. It relates to, how shall I put it, underprivileged areas, these enterprise zones that the government have popped up, 21 of them I think there are now, around the country to encourage investment into those particular areas. And we're working with one particular case in Margate. And I was just about to say Ramsgate, thinking I always get the two mixed up. But in Margate, look at this place. That looks good, doesn't it? That looks nice. I went to see some people down there, and I went onto Google, and I said, right, okay, find me a nice hotel in Margate. And do you know what the answer was? Do you know the nearest one they found? Southend, which is, for those who are good at geography, nowhere near Margate. So I thought, oh, that's really not very good. So I drove down in the morning, it was very early. I think I got up at 4:30 or something. Anyway, got there, met them for breakfast, and they said, we're going to buy this building, and they've already bought it from the local council, no tax issues, so they can claim the capital allowances. They're going to use the BPRA scheme as kind of an investment incentive for people to invest into this particular project of theirs. This is just purely for example. This is going to cost over £3 million. The capital allowances is going to be almost as much as that. So the people who buy into this partnership as it's going to be structured can benefit from massive tax relief, purely because they're taking advantage of this BPRA scheme. And it's something that applies to the particular areas. I had a list of all the BPRA all the enterprise zones. I'm not sure there's any 2 near here. But effectively what this is this going to be structured in a partnership. So people will invest in the partnership, get the tax relief based on the BPRA, and they're structured it in such a way that you're in for 7 years. They'll guarantee a return per year. There's some numbers that you can all look at some point if you're interested. And there's a buyout at the end of it as well. So that's that. Land remediation relief. Now, land remediation relief, that sounds really dull, doesn't it? Again, the revenue is very good at this sort of thing. They talk about land, and what they actually mean, is land and buildings. But of course, how are you supposed to determine that from land remediation relief? But it relates to any cleaning up of contamination on land and buildings that you undertake. It has to be done by a company, but it is the biggest single tax relief the revenue offer at 150%. So, if you buy a building that's got asbestos as a prime example, or even if there's elevated levels of arsenic or radon or whatever it might be, and you have to remediate it, you have to clean it up, you're entitled to claim 150% of those costs against your taxable profits. Who here knows what a petrol station looks like? Yeah, so you don't have to raise your hands, I assume that you all would. You've seen these cleaners who take over these petrol stations. Prime opportunity. You also see people who buy up old petrol stations and clear them out and build houses. Why are they buying those old petrol stations? Well, one of the reasons, I'm sure it's not the commercial decision behind doing it, but they are contaminated. As well as building the houses and selling them off for a profit and what have you, any money they spend taking the oil out the ground, the tanks, anything they spend, they can claim 150% against taxable profits. And if you're spending £50,000 cleaning up that land, that's £75,000 profit you can make before you even start paying tax. Interesting little thing there. But one of the great things about this, I think it only applies to this and R&D tax credits. We love an R&D tax credit. If you make a loss, you can actually surrender that loss to the revenue and get cash back instead. Who loves cash back from the revenue? Oh, I get so excited about that. I'm glad you can't tell at the moment, though. So, if your company makes a loss by claiming this land remediation relief, you can phone up Mr. Revenue and say, "Hello, Mr. Revenue, I want to surrender my loss. Can I get the money back on the tax of that loss that I would have paid?" And he'll send you a cheque for that. Something for you to be mindful of. Of course you can.
I've got a property, and you've actually done the capital allowance on it for me, but I had a leak in the boiler house. And
Sorry to hear that.
When they came to clean up, they said, "Oh, there's asbestos."
Mm-hmm.
So I'm going to have to spend $1,000, $1,500 getting it cleaned up.
Yep.
Can I claim that under LRR?
It has to be claimed by a company, so if you have it in a company name, then you can do that. You have to get a report or some confirmation that there is asbestos available.
Have that.
You have to identify all of the costs that you've incurred related to it,
Yeah.
in which case it's very easy to put together the information and do that.
Fantastic, thank you.
It was worth coming today, wasn't it? So there you go, land remediation relief, excellent. And here's an example of this. A client of ours had a big factory in Nottingham. I shan't tell you what he makes, but it's quite an interesting business. And yeah, obviously, a lot of these old factories, there's asbestos everywhere. They've had an asbestos survey came in, and they had to do the work anyway, but it was a bonus that they could then claim the land remediation relief, and that saved him £6,000 off his tax bill. Considering that he spent £18,000 on the work, well, that's a third of it back. So if you look at it that way, it's good. Enhanced capital allowances, yeah? Let's have a guess what these are about. These are capital allowances that have been enhanced somehow. Other types of plant and machinery, there's a great big long list of them on the Revenue's website, the ECA, enhancedcapitalallowances.gov.uk. I'm sure you've all been there. But if you're investing in assets, investing in new boilers, all these sorts of things, just have a look at this website. It's free. you can go there, and it basically lists two types of enhanced capital allowances. One, it lists things which are mass-produced, things that are everyday. So if you're going to buy a boiler which costs £1,000, and on this list here, there'll be another boiler which meets the revenue zone guidance when it comes to energy-efficient boilers, that's £1,100. Well, you might want to consider buying the more expensive one to then make sure you get the enhanced capital allowances rather than nothing at all. And that's something that there's loads more information on that particular website about that. But that's one thing where it's all mass-produced items which are very clear. And manufacturers now are generating more and more energy-efficient plants in order that you will then buy their item over one that doesn't qualify, and therefore that's their incentive. And the revenue give this tax relief to meet their carbon footprint agreement. Yes, sir. Oh, sorry.
If you're incurring that expenditure through your company to replace that equipment, can you still claim that as a personal tax relief?
If you're the legal owner of that asset is the one that can claim the tax relief. So if your company is the one that bought it and owns that particular asset, your company is the one that could benefit from it.
So it becomes a corporation tax deduction?
Exactly so, yeah.
I'll follow on to that.
Of course.
Presumably, if the boiler that you bought was a replacement for a similar boiler, and it's already assumed by your accountant to be a replacement,
exactly
in which you're claiming a normal tax relief and expense, you can't claim it twice through a capital allowance, can you?
You're perfectly correct, yeah.
You can't claim it twice. Yeah.
No, whenever you're buying something, you would first need to determine if it's a capital addition, an improvement to your property, or if it's a replacement. And again, the clue's kind of in the name here. It has to be a capital allowance. So, as you rightly said, if you're just replacing a boiler like for like and there's no improvement, then of course it would be written off against your profits in that particular year as an operating expense. But if it is an improvement, if it's a new build or a development, and it's a new asset, then it is a capital asset, in which case you're entitled to claim that. But thank you for the question. So they're enhanced capital allowances. So they form a long list of all these things. Just go and have a look at the website. I'll warn you, it's not that exciting, but there's lots of information on there. There's a list of all these technologies, and also there's items which aren't on the list. How are you supposed to know what's not on the list? Well, these are things that aren't on the list are things that will be big, bespoke projects where you have to get them certified. So, for example, if you were installing a combined heat and power solution, because each one is designed for that particular building, you could still claim that, but you would have to make all your measurements and go to the ECA with your documentation, and they would have to certify it, and then it would qualify. But that's only for a really big one-off.
What about solar and PV systems?
Yeah, if it's on the list and it qualifies, it is literally a list of the manufacturers and the make, model of that particular asset. And if you bought a boiler where it says Potterton boiler number 1234 and it's on that list, then it qualifies. But if it's not on that list, it won't qualify. But have a look at the solar installations. So pooling. So a few more things before we get on to the really exciting bit. So from April 2012, the Revenue introduced certain rules around buying and selling of properties with capital allowances in mind, and this Section 198 election that I mentioned. And what they're doing is, from April 2014, there's some rules where you can't actually buy a property unless a capital allowances exercise has been done on the premises. Otherwise, you could potentially lose out and get nothing at all. So just be aware, any properties you buy from next April, I keep thinking it's 2012, any properties you buy from next April, capital allowances will be a bigger part of it. So just an example of missed opportunities. I'll go back to this capital allowances, Section 198. A client of ours bought an old B&Q site up in Yorkshire for £5.6 million. Yeah, that's a lot of money. They didn't even really concentrate on the contract too much. They left it to their solicitors. They agreed a price, But in the contract, it said that in the purchase agreement, the election for plant and machinery was set at £1. So how much tax relief could they claim on that particular purchase? £1. And we estimated they could have claimed about £1.6 million. So, you know, it was their loss. Yes, sir.
I have a little experience of this as I'm a commercial property solicitor, though this is not my area, but just to warn people that some vendors deliberately do that because some of them can reclaim it, and so they will set it at £1, so they keep all of the allowances.
Yeah, exactly so.
Whereas you should be able to negotiate some portion between vendor and purchaser. So if this is of concern, then make sure you have solicitors who know what they're doing and can negotiate it properly for you.
It sounds like you're just the person for that as well. But you're exactly right, and this goes back to the pooling issue that comes into force in April next year, because it is such a big thing, and because the plant and machinery value is sometimes a point for negotiation, whereby, and I've had it recently, just in the last weeks, a client of mine was buying a property in Leicester, and the previous owners could claim some capital allowances, but it wasn't very much, and that was a negotiation on the price to transfer those allowances over. But there's some missed opportunities. So some quirky allowances, just a few things to cover you up with. Now, I want a show of hands, very quickly. Who enjoys a caravan holiday? Yes? Don't be shy. Come on, I know there's more of you out there. Caravans are deemed to be items of plant and machinery if they meet certain rules. There's some rules there. It has to be on an authorised caravan site, and it has to have normal trade usage. But the caravan in its entirety is an item of plant and machinery. As well as that, no word of a lie, this next item is an item of plant and machinery. Look at that. I was choosing this picture and I said to my wife, let's get a big angry sheepdog like that. And she said, no, get like that, and all the women will go, oh. But she was right, as usual, but I don't tell her that. So sheepdog is an item of plant and machinery. As long as it lives more than 2 years, of course. If it lives less than 2 years, you don't get the tax relief. It says sheep and horses and cows aren't capital allowances, because that would be ridiculous, right? Of course, unless it's a working horse or whatnot. But there you go. So sheepdogs. So next, when you come to the pub quiz on Sunday and they're talking about sheepdogs as plant and machinery, you know the answer. Thank you very much for your time, everybody. I shall be around for the foreseeable. Thank you.